Hello everybody, my name is John Locke and I'd like to welcome you to The Winning Trade. But first, the required disclaimer material. This presentation is given for educational purposes only. We're not broker dealers or financial advisors and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and please make sure you're aware of all your risks prior to placing any trades. Also note that in this presentation, we are using hypothetical computer simulated trades. They're believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many, many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance and success coach with Lock in Your Success LLC. And myself and my team of mentors are here to help you win in the markets and in life as well. And the types of strategies that we specialize in are called income or high probability options trades. Now, if you don't know what these are, we will be explaining this to you as we go along. But essentially what's going on is we're putting on trading strategies or option strategies that benefit or make money through the passage of time rather than depending on price movement alone, meaning you can often win whether the market goes up, down, or sideways. Now, this doesn't mean we're going to win all the time, but it does put the probabilities much more into our favor of having winning trades more often. Now, the winning trade that we're going to show you today is called an X4 version 14. It's one of the three trading strategies that's in our X4 options trading program. Now, the X4 version 14 is a conservative, market neutral, broken wing butterfly trading strategy that we do on the SPX index. It's going to require a minimum capital of $2,250, and we're going to do an example size today that's $22,500. With this, we have a profit target, and that profit target's 11.1% of what we call our planned capital, and that's going to be $2,500 on our $22,500 planned capital, and we also have an exit loss trigger of the same amount, or 11.1%, which is going to equal $2,500 on our $22,500 position. Now, when we talk about planned capital is the maximum amount of money we would expect to get in the trade, regardless of how the trade goes. Now, most of the time in the X4 version 14, we're going to have much, much less than our planned capital in the trade, which actually creates higher yields than we're showing you here. However, we do figure our profits and losses off of this planned capital number in order to help you compare better on how the trade's doing, because there is a possibility we'll get that 22.5 in the strategy. So what you're seeing here is a piece of software called OptionNet Explorer. Now, what OptionNet Explorer does is it shows you the risk profile and the profit profile in your position. This type of software is extremely useful when we're trading these more complex option strategies, is what they call them, where we have multiple long and short calls and or puts in our position, and it sometimes can be a little bit complicated to imagine what that's going to look like. So for example, if you bought 100 shares of stock, you know if that stock goes up $1, you make $100. If that stock goes down $1, you lose $100. You can intuitively think about that in your head. But when we start buying calls or puts in certain areas and selling them in others, it gives us a very distinct profile on where we make money and where we lose money. So it's not always so intuitive. And this software really helps with that. So what we have here on the right is we have a graph, and we have a flat or a series of straight lines that look almost like a triangle, and that is known as our expiration line. And what that means is, let me widen this out a little bit. What that means is if we were to let this position go to expiration, so when we buy option, we do an options position, we have an expiration. If we were to let this position go until those options expire, then we would be able to tell how much money we would have made or lost at any given price point. So the SPX price points are down along the bottom here. Our potential profit and loss is up along the right side. And for example, if the asset price or the S&P 500 were at 3,400 when our options expire, if we were to do nothing with the position, then we would make a little under $5,000, looks like about $4,000 in the position. And that's basically how that works. If we were back here, it kind of tells us how much money we actually have in the position, because this is going to be our maximum amount of risk in the position. And if the market were to come all the way down here and you were to do nothing, with the size of the position we have on, we'd lose about $16,000. So as we said before, this is a $22,500 position from a planned capital standpoint, but notice we only have about $16,000 in it. That's pretty typical. When we do adjustments or we move things around, we may end up increasing that capital level up to the 22.5, but we may never have an issue either. So we'll see how it goes as the trade goes along. Now over here, we have our options expiration cycles. So here we have our December 18th, 2020 expiration cycle, which is the one we're going to trade. And then over here, we have our weekly cycle for the same date. And then over here, we have our January 15th, 2021 expiration cycle. So this is a December 2020 expiration trade. We start the trade 77 days to expiration. This is telling you that this option expires in 77 days. The date that we're on here for a starting date is October 2nd, 2020. And what we're going to do is we're going to do a formation of complex option strategy. It's a formation called a broken wing butterfly. So a broken wing butterfly is when we have, if you know what a vertical is, it's essentially two verticals that face each other, one being bigger than the other. So we're going to sell 20 of these 3320 options, and then we're going to cover those short options by buying 10 3260 options 60 points below this, right? So there's what we call a 60-point wing on the lower side, and then we're going to buy options at 3360, which is 40 points higher than our short options, which are here. And that's going to give us a 40-point wing to the upside. And this is called the upside over here. The downside is over to the left, and you can see the downside and the upside on our matrix. Now this is going to give us an expiration profile that looks something like this. Now when we put this position on, it's going to produce a certain delta. So by that I mean, let me just imagine we took this off. So by that I mean, if we look at the model position, it shows us we have a delta of 14.36, and that's a positive number. What that is telling us is that if the position goes up $1, or the asset price goes up $1, we're projected to make $14.36. If it goes down $1, we're expected to lose $14.36, as we currently are here. And we use this delta number here. If it gets too high, then we're generally going to make some sort of an adjustment to get it to be a little bit less. Our idea is we want to make money over time. When we initially did our broken wing butterfly, we had a positive 14 delta. That's actually too much for our entry position. Our entry position is limited to how much delta we can have, and we want a maximum of 9 delta on this on our entry, and we have 14. So what we're going to do is we're going to buy what we call an extra put. So we're going to come in here, and we're going to get this under 9 by buying this 2540 put, which adds or subtracts 5.7 delta from our 14, and that brings us down to 8.66 delta. And that gives us our entry position. Now from here we have the little red dot. The little red dot tells us our current profit and loss on our position. That red dot has a line associated with it. This line is called the T plus 0 line, and this T plus 0 line tells us what our position is worth today, or is projected to be worth at any given price point on the SPX. So if the SPX went all the way up to 34.40, you can see that it shows a profit of about $597. If it goes down all the way down to say 3,300, you can see we have a loss of $604. Now you might say, well, if I get this really big up move, that's not a lot of money to make. But that's because the position isn't designed to make money on price movement. The position is designed to make money through time. So what happens here is as time goes by, this T plus 0 line gets closer and closer to our expiration line, and that being the case, we can make money if the market doesn't have to go up for us to make money. We can make money if the market sits and does nothing, and we can even make money, and in fact, we can make more money if the market comes down a little bit. So we're making money over time, meaning that we can get really big price movements here. We don't have a whole lot of impact on our profit and loss, but over time, we're going to generate profits. It's really a very high probability way of making money. But anyway, this is our entry for this position, and that's how it works. Now from here, we have a profit target of what, $2,500. We have a maximum loss of $2,500, meaning if we draw down $2,500, we're going to exit the position. If we get below our short strikes, which that would be 33.20, we're going to take this off and we're going to reposition it. And then to the upside, we're going to exit if we hit our profit target, or we'll exit if we get to the point where our February expiration cycle is 77 days to expiration. So we don't plan on taking this trade all the way into expiration. We're only going to be in it until we either hit our profit target, our loss, or February monthly cycle, which is here, gets 77 days to expiration. So let's take a look at how this goes, and you can see how the position unfolds here. So we get a really big up move. Notice how profit and loss doesn't shift very much, right? But we're not really making anything because no time's passed, only a day's passed. But you can see how it doesn't affect us a whole lot. So let's move this again. All right, the market comes back down. And this time the market really, really takes off to the upside. And let me just go, I think there was an adjustment with this. All right, so we go all the way over to the 28th. So look what happened in the price chart here. We had a very substantial up move from when we started. We ended up gaining a little bit of profit with that. But then we had a down move, and now that down move is really, really picking up to the downside. So we end up coming all the way back to here, and we're drawing down a little bit, $570 on a $2,500 maximum loss, not very much. You say, yes, time has passed by. Realistically, in most cases, this would actually be up a little bit of money here. But we also have something called implied volatility, which also affects the value of our position. And it caused a bit of a drawdown, which is not a big deal. But what we do is, since we went back down and we passed under our short strikes here, we are going to take this and we're going to reset it to starting position. Now, when we were at starting position before, you noticed that, or you should have noticed, that we had a 40-point upper wing, 1, 2, 3, 4. We had a 60-point lower wing. What I didn't mention, but I'll mention now, is when we start, our long strike, or our upper long strike, is at the money. So right now the asset price is 33.04. That puts our upper long strike at 3,300. And then we have our 40-point wing, we have our 60-point wing, and then we have our put position way down here at 25.40 to bring our delta down under +9. And we basically start over again. So from here, the market actually did bottom right around this area. And you can see we're having a bit of an implied volatility thing going on, which gives us a bit of a drawdown, but time will take that away, as they say. So you'll see that come out of the position. We are now back to a positive $612. And basically from here forward, there was nothing to do in this position as the market stayed up at this level or higher for the duration of the trade. So let's just ignore trades for a second. Let's go to our next adjustment. And at this point, we are what we call 14 days to expiration. The asset price is all the way up to here, or 36.92. Our profit and loss is 21.22. So we're near our high profit target, but we're exiting because of time, right? We said we're going to get out when this February position is 77 days to expiration. So we are popping out of it here. And we're going to close this for a profit of around $2,100. So that's going to be about 9.5% profit, where all we did, okay, so keep in mind that essentially 2 months went by. All we did is we entered a position. We had a little bit of trouble to the downside, so we closed the position. We opened it up a little bit lower. I don't know, it was about 8 or 10 days later. And then from there, we sat and did nothing until today, and we simply closed the position at our 9.5% profit. At the same time, these trades do overlap, so we would have also had a January trade on. So if we take a look at our January trade, we'll just quickly look at that one as well. So I'm going to go back to entry date. Let me scoot back here, zoom out. There we go, I'm in the wrong place. Our entry date on our January position happened to be right here, when we had a 64-point down day or 68-point down day in the SPX. That's actually a really nice entry when you can get those. So we had this nice down move into here. We came in, and January expiration cycle, 77 days to expiration, just like it was in December. We come in and we buy our long strike at the money. In this case, it was 32.41, so we have a 32.40 long options. We sell 40 points under, we buy 60 points under that. We bring our delta down with, actually, no, we did not need to bring our delta down in this case. So we don't always have to buy puts on this position. We'll buy them if they're required on entry, but right now you can see our entry delta with the broken wing butterfly in isolation is only 5.92 positive. So there's no need to add any put protection to this. So this here is our entry position. And you can see by the trade log here, there were no adjustments. So we entered this on 10/30. We exited it on January 4th, which is when our March expiration cycle is 77 days to expiration. So we had an entry trade, we had an exit trade in 2 months. We did nothing in between. And this trade here, if you sat in it, paid off $2,294 on a $22,500 planned capital. So that's about 11% in 60 days. So when we go to our exit day here for January, and we're exiting because, again, our March is going to be 77 days to expiration. If we fly out to March, actually it's 74, that's because of the holiday. It's 74 days to expiration. You can see that this position here is up about $2,300 at this point, and that's all that happened. Those are the only adjustments. So that is the X4 version 14. That's 2 samples of this super strategy. It did fantastic in 2020. It's continuing to do fantastic in 2021. And I'm really looking forward to both trading it for the rest of the year as well as teaching it to you. So that was the X4 version 14, this episode's winning trade. If you like what you see, I encourage you to come on over to lockeinyoursuccess.com. That's LOCKE inyoursuccess.com, and check out our Go and Pro memberships, where you can find this and many other great strategies that we trade on our Options Trading for Income webinar that we do every Monday morning, and we've been doing for over 800 episodes. With our Go membership, you can get access to over 800 recordings, and you can watch these trading strategies that we display play out week after week, month after month, and year after year for over a decade. It's an incredible, incredible value. Also, come on over to thewinningtrade.com, that's thewinningtrade.com, and learn about upcoming winning trade presentations, and you can also explore our past winning trade explorations, and you can see other examples of these trades that we're displaying, even the X4 version 14, over the last several years. And don't forget to check out last episode's winning trade, as well as the one before that, when we did our voting for winning trading strategy of the year for 2020. That shows you the performance results on many of the strategies that we're displaying here on the winning trade for the year of 2020, which we all know was an extremely up and down challenging year. It certainly wasn't market neutral, yet these market neutral strategies did fantastically well. So the other thing that you can find at thewinningtrade.com is you can get free bonus material as well as access to our trading success blueprint that will help you or give you the path to becoming a successful trader. And also, perhaps best of all, check out our free trading performance podcast where you can learn to skyrocket your trading results regardless of the type of trading you do. If you have any questions or comments or anything you'd like to see on the next winning trade, please feel free to comment on this video or email us or contact us within our contact form, and we'll be happy to answer your questions for you. Thank you, and we'll see you on the next winning trade.